SMB Investor with Nick Bryant and Sean Smith.
Hey everyone, you got Sean Smith here, managing partner of Search Fund Ventures and founder of SMB Investor Network. And today I'm joined by Mitch Petracca, founder of Forward Firm. He's been a long-time CPA and quality of earnings provider for searchers and just generally been supporting the small business acquisition ecosystem for a while. So Mitch, thanks so much for joining us.
Pleasure to be on. Thanks for having me.
Absolutely. Why don't you kind of kick us off, give us an overview on your career, your background, and then tell us a little more about Forward Firm.
Yeah, I would love to. So, I'm a CPA by trade. I went the very typical CPA route of starting at PwC, more in the audit and accounting practice there, where I was working on larger public companies, and then found that I didn't love being on the same clients again and again and wanted to move into the more strategic world of transaction advisory. So I joined their financial due diligence group and was there for several years doing more upper market public entity transactions with large PE firms. Very different feel from where we are now, and a lot of changes and takeaways from that world, but a lot that has, since changed in terms of my approach of doing quality of earnings and financial diligence. I later moved down market and found that there was a lack of sophistication, especially at the time. I think we're moving in the right direction as a macro trend in the lower middle market, Main Street kind of bands, but wanted to start my own practice of really advising and helping facilitate the movement of searchers and independent sponsors primarily. Also work with a number of small private equity firms and acquisitive corporations doing roll-up strategies and such. So generally, I'm involved in kind of $1 million to $50 million EV transactions and bring some of that lower middle market approach. I also, mentioned, have since merged my firm with a tax partner into Forward Firm. So a little bit of a name change there from my previous company, which was Petracca Group. And the real catalyst for that was being able to better serve clients around the continuum. So after the deal as well, in terms of giving them better tax strategy, supporting their bookkeeping and fractional CFO works as well. So now we're a fuller suite of services, and we leverage a ton of technology and such to do that. So excited to bring that into the market as well.
That's always been kind of something I've loved about your approach. You're always looking for new ways to introduce software and workflow automation and AI, whatever it might be, into the work you do. So why don't you tell us a little bit about some of what you've done that's worked and what you're planning to build that out to?
Yeah, absolutely. So I've always been a strong believer in leveraging technology to, get to insights quicker. And a large part of that is, really trying to get better outputs from our work, right? And so trying to eliminate a lot of the manual processes. So that actually started at PwC. I was on their nationwide deal team trying to think through how did they do that on a large scale level. So I was a team of 3 people that were basically developing a software internally for PwC where they called it the common deal model at the time. And so we were actually developing that software for how do we ingest all these trial balances and get to the quality of earnings workbooks that, a lot of us have seen as quickly as possible. So I brought that same love of technology into our firm. I'm using a ton around the administrative side with N8N and Zapier and other automation software. So anyone who knows me knows I could talk about those for hours. So a bit of a can of worms you've opened up there, Sean. But as we do it at Forward Firm, we have a client portal. We've got things like you can use the mobile application to take a picture of a PDF, and that actually OCR scrapes it on our side where the AI is able to read the tax returns, and then, it just makes the work a lot more seamless, right? So what that means is we can pay better advisors, right? Because they're spending fewer hours on each engagement. So that's really the formula that we've put together is how do we get people the best bang for their buck in terms of value, right? For what they're paying for. And so that's where I think the technology can really bring better quality for the same price, if you will.
Very neat. Kind of giving different tiers and using different levels of technology when it's, feasible and accurate, and then kind of stepping in with some human in the loop as needed to kind of round things out. That makes a lot of sense. And that's a great segue, I think, into one of the topics you talk about. And people talk a lot about quality of earnings as sort of a quantitative and arguably mathematical exercise, but in many ways there's an art to it, right? There's an art to getting the answers to the information you need and getting all the requests fulfilled, and also an art to not, rubbing anyone the wrong way when you're sending over a request for what's a very detailed amount of information about a business. So why don't you tell us a little about how important and kind of how you approach that softer side of the QOV?
Yeah, I think that's a fantastic point, and one of the biggest takeaways I've had in transitioning from upper market work into where, we sit today in the market. And a big piece of that comes from the fact that most of the stakeholders haven't gone through an M&A transaction before. So we always like to have that in the back of our mind as a team when we're going in and doing quality of earnings is how sophisticated is the counterparty and how do we meet them where they're at in terms of helping them understand the questions that we're asking, using their time very effectively, knowing that they have an operation to run and that they're busy business owners, right, at probably the greatest inflection point typically of their career, right, when their life's work is being handed over to a searcher in many cases. And, how do we show up with a friendly face so that, we make this really painful process a little bit less painful for them. And, part of that, Sean, comes from I was actually the target of due diligence myself when raising a $100 million Series A for a startup I was, fractional CFO for. So I was the subject, ironically, of PwC's due diligence at the time. And that's where I had a lot of these takeaways from being on the other side of the table of how do I run a better process? And as we know, momentum is super important to a deal. And so we view ourselves as partners with our clients, right? Where we're trying to augment their process. And, unfortunately, I've seen quality of earnings go the other direction too, right? Where someone that's more of a mid-market firm tries to do a search or diligence and it's a little bit too intense and it just creates friction within the deal, which is not what you want, right? So it's about getting the answers that you need, but getting them in a thoughtful way where you're really keeping the importance of the deal as a whole top of mind.
It's so important, if you go in with a hard-nosed approach and you're demanding tons of information, especially if you're asking for stuff that maybe the searcher's already gotten or it's redundant or God forbid it's like unnecessary information that you just are sending a boilerplate request list, that's the number one way to kill momentum and kill trust. Right? You got to take that tactful approach. And this applies to any diligence work stream, right? Answer as much as you can yourself. Don't make any assumptions. If you have a question, ask it, but do the work you can up front to ask thoughtful questions. And I know in my career, when we've taken the approach of being much more deliberate and asking thoughtful questions during a diligence process, it goes a long way for the seller, especially if they're running a process and they're getting tons of diligence questions from lots of different folks. They can tell when it's boilerplate and when it's well thought out. So it's a great point. That's a great, I think, unique insight that a lot of folks don't think about when it comes to kind of the quality of earnings, the process there. Similarly, I think when you think about the adjustments, there's also sort of a softer side to evaluating all the adjustments that sellers will make. And then folks like yourself, when doing the QV, will kind of verify and accept, right? So you've told me that there's different tiers that you'll look at when it comes to adjustments. Why don't you share a little more about how you think through that and what those different tiers look like?
Yeah, I would love to, Sean. So that's one of the first things I generally consult clients on is understanding what a quality of earnings means. And a big part of that is understanding that there's subjectivity and gray within the quality of earnings, right? Many people think, give me that definitive EBITDA number that I can underwrite. But the reality of the situation is generally, if you do 5 different QOVs with 5 different providers, you're actually probably going to get 5 different answers as to, what that bottom line EBITDA is. And the reason is due to that subjectivity of what is an adjustment, what isn't an adjustment, what do we feel comfortable signing off on as a CPA? And the way I like to think about this is from a tiered perspective, like you said. So the first tier is essentially definitional, basically meaning everyone in the ecosystem completely agrees this is a definite, an adjustment no matter what. So good examples of that are obviously depreciation, interest, those types of things that are right in the name, but also like contributions, donations, where it's very clear that that is not business related. And so no one's going to bat an eyelash, right? They'll see that adjustment, they'll move forward and agree with it. Then there's a second tier where it's a little more subjective. So those are things like discontinued product lines or lost customers, things where you need to prove it a little bit more to a lender or to an investor for them to accept that this is a valid adjustment. And then there's a third tier, which I would call things that most people are not going to really underwrite as part of their EBITDA. And so that is, things like travel and expenses, where it's very difficult to really verify that this doesn't relate to the company's benefit, right? And to that EBITDA. So a great example and way I like to think of this is, let's say that the counterparty took a flight to Chicago, right? And they say, let's add that. That's part of my travel budget. And, you don't need to do so much travel. Well, potentially they visited a client. It's very difficult to prove that back. And, some of the advertising or marketing that brokers or sell side like to add back. Similar idea. How do you know that you're actually going to receive that same benefit from a revenue perspective, right? And that it's going to stay at what it was. Very difficult to prove back. So almost no lender, almost no investor, who's been in the space for a long time would kind of accept those as adjustments. The way I like to view those and the way I talk to my clients about them is they're kind of like a cherry on top, right? They represent potential upside. We're not going to bank on them, but it's great if that's true and, it is realistic to happen. So maybe we give a little bit of credit in them, but, it's not something that we're banking on.
Yeah, and I think that's really important for both buyers, but also investors to understand. It's almost a personal risk tolerance decision to say, hey, what level or which tiers, to use kind of your framework, am I comfortable accepting, right? The Q of E may come back and say, here's the adjusted EBITDA figure, but in the footnotes, it might say other adjustments that were considered but not accepted include X, Y, Z. And as an investor, you might know the industry very well, or you might say, based on my experience in this space, we can accept those. Or you might be a little more hawkish and say, even the adjustments that the Q of E, the CPA firm accepted, we're not gonna, include those in our calculation because for whatever reason, we just don't. We believe the company benefited a lot from the donations it made, and those were more of a business development strategy or a marketing strategy.
Absolutely.
It's sort of a risk tolerance question as well as an actual financial analysis, if that's fair to say.
Yeah, absolutely. I think the reason that, clients choose us is because of that advisory piece, Sean, right? Not only are we saying what the adjustments are, but we're saying how they impact your deal and how you should think about and incorporate what the finding is into your overall deal structure. And part of that is the fact that I've done deals myself, right? I've actually executed end to end on the spectrum, so I can help see around the corners of this will actually have an implication post-close as well. And so it's not just about having a finding and then immediately saying, don't do this deal. We saw something that's, wrong or something like that.
Right.
A lot of what's wrong is painted as fraud, but typically, right, they just don't have the CPA support on the sell side, when you're operating a business. And so it's more just mistakes or not understanding, or maybe they are trying to hide something, right? But regardless, it's more about what does this finding mean for our deal, right? And so what we like to do when we have a finding is help our client really understand what does this mean for your deal relative to the increased risk that it brings, trade, some of the deal structure. How would I think about doing that? And what's the magnitude of the risk, right? So everything is kind of in a spectrum. And you can think of it as a financial modeling exercise where you kind of have your downside case, your base case, and your upside case, right? And a great example is a recent deal I did where they didn't actually track inventory at all throughout the year, despite having inventory. And so they had a big question mark there, right? As to how do we do that for net working capital and what's our risk when we, get into the company post close. But I have this fantastic purchase price that I'm willing to accept a little bit bigger, right? So our advisement there is this is our blind spot. This is, the range of outcomes and the level that it could impact your deal. And again, it's just a little more qualitative. And, that's what I love about QOB is it's an advisory capacity, right? It's not just let's do an audit and the audit's either right or wrong.
Yep, that's great. And it dovetails nicely into where you're kind of taking forward from, right? With the tax advisory and all the additional advisory services you guys have. Very cool. Well, other thing we spoke about is what should buyers and investors actually do with the findings once they get them? And we just kind of talked about how to interpret various tiers and adjustments to EBITDA, but there's a lot more in a quality of earnings report, right? There's the working capital analysis. There's often the customer concentration, kind of a quality of revenue type analysis. There's the margin bridge. There's all these different kind of outputs. So for an investor that's receiving one of these, it's probably been through a few iterations with the buyer, the seller, and the CPA firm. What are some heuristics that investors can kind of use to say, okay, I'm starting my Q of E analysis. Here are the first three things I should look at, and here's how I should interpret them.
Yeah, that's a great question. So, Sean, the first thing I do when I look at a Q of E is I try to go directly to, the bottom line EBITDA number like everyone else does. But I actually then work backwards, right? And so I think through those tiers that I just talked about, and I try to think to myself, well, how solid are these adjustments, right? Is this something where I really feel good about underwriting it? How soft are some of them? What is the range of outcomes of some of them? So a great example is anything pro forma, which basically means as an example, right, we acquired a company midway through the period that we're looking at it for a Q of E. And so you're going to like bring that back and pretend as if both companies were merged the entire time, right? Well, is that range of outcomes true where there actually might be synergies between them, right? Or there might be something that changes that adjustment from like a quantitative perspective. So, what I'm doing is looking at exactly what is the strength of the adjustments as well. So a good way to test this is what is your reported EBITDA versus your adjusted EBITDA. So, the quality of earnings is essentially a bridge between those two figures. And if your reported EBITDA is higher, right? Let's say your adjusted EBITDA is 2 million. If our reported EBITDA is 1.5 million, that's a lot stronger than if our reported EBITDA was 500,000 and we had 1.5 million of adjustments to get to that same $2 million adjusted EBITDA number, right? So that's really important to keep in mind because that essentially affects, again, your range of outcomes, how you're going to think about modeling all this out. So that's how I look at the quality of earnings piece. I always want to look at the cash proof. That tells us how accurate are the numbers, right? And generally, we like that to be under 2%. The other thing I look at that not everyone understands is cash proofs need to be done from both sides. You need to do both the inflows to the bank statement, which you match with revenue and accounts receivable, but you also need to do the outflows, which match with expenses. Many quality of earnings don't do that second part because it's difficult. It's harder to do. And your risk there is that you haven't actually agreed everything in the financial statements to the bank statements. And so these are companies that generally aren't audited or reviewed. And so that means there's a little bit of a risk there where you're actually assuming that the numbers that they give you from the financial standpoint are correct, but maybe that hasn't been tested. So that's important to know. Then obviously net working capital, what's the trend look like? How should we think through the peg? Similar idea with the adjustments, right? How strong are they? But then also you want to look at revenue and product mix is like a huge one that a good quality of earnings report should have in it. So there we try to think through what are the margins of each of the products and service lines and how strong, is the information to help you determine that, right? A lot of the times we would like to determine that, but you don't have the historical information to actually do that because the seller just kind of recorded everything as one line item in revenue. Right. So that's always really, really informative too, when thinking through modeling the company and how do I, understand what really drives the success of this company.
Yeah, that's something we love when we drill down to the gross margin or ideally kind of a contribution margin by product, service, and even customer. I mean, that's about as good as it gets. It's very rare to find that. We ask for it. I think we get it maybe like 5 to 10% of the time. But
that little, wow, yeah.
Well, it was more in larger deals, but yeah, maybe I'll start to get proved wrong now that you're doing more kind of software enabled QVs that can suss that stuff out. But no, I think a lot of times it's just hard to access that because to your point, what we see frequently is certainly kind of one revenue line item, but even more so just in a service business, time tracking isn't granular enough to really attribute like what's direct labor versus what's a operating expense item.
Absolutely.
Things like that are just virtually impossible to adjust retroactively end up making it infeasible to have a gross margin by product, service, or customer. But to your point, if you can get that can give you a lot of great information, especially when you can look at those trends year over year. So yeah, those are great highlights for investors, understanding how much potential variability there is between reported and adjusted EBITDA is a really important concept. Like you said, if you're going from 500 to 2 million, there's a lot of room in there that's more uncertain than if it's a smaller kind of adjusted gap. And similarly, when you think about a working capital peg, this is a question I ask folks a good amount, but it's, I wouldn't say commonplace, but it's certainly less well defined in this small business acquisition world that, a business should come with working capital. That's pretty standard in kind of the middle market. So what you end up seeing is owners oftentimes, simply because it's what feels right, believe, hey, I earned that receivable, I should collect on it before the sale. What I've also seen, and I'm curious to get your take on, is owners will sometimes say, well, maybe I'll hold off on paying some of those payables until I'll let the next guy worry about it, right? So you see this kind of decline in receivable days and an increase in payable days as the sale gets closer. And that can impact, if you're using, for example, a trailing 6-month or a trailing 12-month peg, that can impact the number you use, especially if it's pretty material. So how do you guys go about making sure that the peg is actually enough to fund operations and not result in a liquidity crunch, knowing that these sorts of tactics are a little more common in the small business acquisition space?
Yeah, that's a loaded question, and usually about a half-hour call that we have on every single engagement, and it's really important, right? Because you need to have a meeting of the minds, and so it's kind of a piece of each of the topics that we talked about so far. One of the biggest important factors is what kind of sell-side representation do they have if we're on the buy side, right? And how much has this concept been explained to them where they're going to really understand the idea behind it? And, if not, can we help them just get there from a pure understanding? Let's see each other eye to eye and transparently to try to come together and just kind of communicate out the perspectives. It's that you can see exactly what they're seeing and they can see exactly what you're seeing. And so I just had this happen on a deal yesterday where I had to have this exact conversation with the seller because they thought that they, deserved all of the AR. And, really what the point of that networking capital pegging concept is to get, there's the old analogy, right? The gas in the car that you're buying. And basically what you're paying for with an EBITDA multiple theoretically is the ability to earn that EBITDA again and again every year, right? And so you can't earn that EBITDA again if you don't have the resources to do so. Not having the resources would be not having the gas in the tank, right? Not having the receivables and everything operating the exact same that it has been this entire time, right? And that is really the easiest way that I like to explain it to, sellers that haven't been through the M&A process is we need the business to operate exactly like it has been. And a lot of the times they say things like, well, we have more inventory now because we want to ship to, clients faster. Well, if we didn't have that same level of inventory, maybe we wouldn't ship to clients faster and then we wouldn't be able to recognize the same level of revenue. There's no way of knowing as a buyer in that standpoint that you're going to be able to keep up what the business has been doing performance wise, right? Unless it's the same as what it's been. And so that's a really important concept. The other thing with networking capital is really you're just trying to approximate in the fairest sense, right? Not being buy side, not being sell side. The fair way to do networking capital is try to just approximate exactly what it's going to be at close. And that's a really important way to think about networking capital as well. So, the adage and the easy way of doing this is what is the last 12 months historically? Because that eliminates seasonality and some other factors. But at the same time, you need to understand, is this business growing? And you actually need more working capital once you've closed, right? Because the trend is actually up. And so it's actually going to be up when you acquire the company, right? And that's a good kind of thing that we can advise the client to be, hey, get ready to fund, an extra 100,000 if you, negotiate the peg lower because it's going to be a higher net working capital, probably the way that this trend is going. The other piece of this, Sean, is just looking at it from multiple angles, right? So when we're looking at net working capital, we're also looking at liquidity, we're looking at cash flow, and we're looking at things like what are your typical outflows and payroll cycles, right? How do we make sure that you have enough if you aren't buying net working capital and they are keeping the receivables, right? I'm never going to say tank this deal because, they're not accepting the net working capital adjustment. It just means you have to know how much more you have to fund. And we look
Yeah.
at things from like a payroll perspective and such.
Yeah. No, then it becomes a purchase price adjustment, and you got to understand what are the actual, back to your expense proof, what are the true outflows during the period when I'm going to have a gap. If I typically have a 60-day receivable period and I'm not getting any receivables in the deal, I need to be able to fund that period of outflows, right? So
Absolutely.
I think that, Mitch, has been one of the clearest and most comprehensive explanations on the varying dynamics of working capital. So appreciate that.
Absolutely.
I would say, just to round it out, any kind of last stories you want to share for the group? Any victories or not so victorious moments you've seen in your many QVs that you've done?
Oh man, I'll tell you, there's a couple occupations where you see a lot of stories. Quality of earnings is one of them. I think, Uber drivers, nurses are probably some of the other ones, but, I've definitely seen a fair share. I've seen, someone put their lake house as a business expense. I've seen people say that they were marketing a company as, putting their logo on their race car and, expensing that whole thing. We've seen quite a range, but, I like really just giving all the stories that help each individual deal, right? And help kind of draw comparisons. And I think that's what a strong quality of earnings professional can do, is draw back on their prior deals to make a comparison to, something they've done in the same industry, or when they've solved this problem and actually gone through it. A big piece of working capital and actually doing this strategy, and I'll tell you this from firsthand experience in acquiring companies myself, like there's nothing like once the close happens, and that's almost the easy part. The hard part now gets to once you're actually operating the company and you're having to manage that cash flow and looking at the bank account each day and like actually living that piece, right? So that's a big part of what we're doing now, which I love, is being able to take quality of earnings and then think through the purchase price adjustments, think through the tax aspects, but also think through like the 13-week cash flow forecast, right? How are we going to help support our client during like this, the most important time of just kind of getting the business off the ground, building up a cushion and like building, the positive momentum of the deal and taking that forward into the new ownership structure. So that's really, something that I've been working hard at, really just continuing to support the clients kind of post acquisition as well. So excited to be doing that in the future as well. Sean, you kind of touched on this too. I just want to plug also, I'm working on a software to really just make this easier for everyone from the quality of earnings perspective and the post-close perspective. So we're automating a ton of what we do from the quality of earnings perspective. And we've gotten this really close where about 60% of QOVs are automated. Everyone who knows about the software has asked me, well, when are you going to fully automate the quality of earnings, right? And my suggestion would be, let's put a human in the loop, and you need that experience, right? So we can get it 80% of the way done. We can condense it into 1 or 2 weeks with the software, but you're always going to want that advisory capacity. And it's really about kind of supercharging those quality of earnings advisors to do better work. And then post-close, just give you better transparency and get more value from the financial data. So that's what I'm passionate about, and hopefully to, bring it to the market in a couple months here.
It's super cool. We're excited to start looking at some of those 80% automated QVs. That'll be neat to see. Any last kind of remarks you want to share? How people can get in touch with you? All that good stuff.
Yeah, absolutely. I'm everywhere the search fund community is. So search fund or LinkedIn, really just however I can be a resource. I love to add value, whether that's, helping build out the team, making introductions, really whatever we can do to help support any of our clients or potential clients even. So reach out to me at mitch@forwardfirm.com. You can go to forwardfirm.com. We've got a tax calculator if you want to look at your tax impacts there. We have the first ever CPA sign up where you can actually go in, click through a cart and itemize exactly what you want to buy from us, and actually even check out on Stripe if you want to. So recommendation engines, all this tech stuff that we're building to really just make it an easier experience where people feel like their CPA is being more proactive, more responsive, and just leveraging the newest tech. So that's what we're all about, and excited to continue helping.
Very nice. Well, we love tech enablement too, so I think we're well aligned on that front. Mitch, thanks so much. Take it easy.
Thanks. Appreciate it, Sean. Be well.